Hi everybody, welcome back to Accounting 212. It's your online course. Today we're going to get started on Chapter 7. We're going to be talking about Cost Volume Profit Analysis, or CVPA, CVP, a couple of abbreviations for that. And this is really where we're going to dive into and see why it's important to understand how we break out our variable cost versus our fixed cost for our accounting system in our companies that we are working on. So before we get started, some of the basics of our cost volume profit analysis here is, creating this contribution format income statement. It's a helpful tool, and we can see here, it's basically showing that traditional income statement, and rather than breaking out our expenses between cost of goods sold and operating expenses, we simply show our variable versus our fixed expenses. So you can see here, this slide's a great slide to kind of give you a breakout or an illustration of what the contribution format income statement looks like. We start with our sales, and we can see in parentheses here that we also have the number of units we sold, so 500 bicycles. We then have our variable expenses, the difference between those, so our first formula that we're going to see, and we'll see it again in another slide or two, but our first formula is sales less variable expenses equals our contribution margin. And we're going to use that a lot, that contribution margin, what the idea of that is, how it's useful. And most of our formulas, if not all of our formulas that we see in this chapter, we're going to use contribution margin. So make sure you understand that. The other thing to keep in mind is what we talked about with our fixed versus variable costs and some of our cost behaviors is this idea of the variable cost per unit, the selling price per unit. So with those two in this chapter, the assumptions are that those are fixed. Whatever we sell our first bicycle here for our 500 bicycles, whatever we sold our first one for, is what we're going to sell our 500th bicycle for. So if we do some simple division, $250,000 of sales divided by 500 bicycles, we can see that we sold each one for $500 each. We can do that same thing for our variable expenses. We sold 500 bicycles, the total variable cost was $150. So our individual cost, our variable cost per bicycle, was $300. And therefore we can use that same contribution margin per unit. Take our $100,000 contribution margin, divide it by our 500 bicycles, and we can see that we would have had a $200 contribution margin per unit by taking our total contribution margin and divide it by the number of units sold. That gives us our per unit contribution margin. And because our selling price and our variable expense per unit, those are constants when we're talking about our business, our contribution margin per unit, that's also going to be a constant. So we can use that a lot, and that's going to help us figure out different levels of activities, and it can also let us, if we're just trying to find different levels of income, we can kind of use a shortcut and just say, instead of selling 500 bicycles at $200 per contribution margin, now let's say we sold 550 bicycles at $200 contribution margin per unit, and we can just come down to this contribution margin, increase it by the increase in bicycles, and then our next line there is fixed expenses, and as we know, our fixed expense per unit stays the same. Therefore, we can quickly come through and calculate our different net operating income. All right? So again, our contribution margin, it's first used to cover our fixed expenses. We can see there it's contribution margin less fixed expenses. So we cover our fixed expense. We have to pay all those vendors, all of our employees, if it's a salary, all the utility costs, etc. And then whatever's left over is our net operating income. So again, we can see this. We can quickly go through, find different levels of contribution margin. We know our fixed expenses are the same, regardless really of activity. So we can quickly go through and say, all right, at a different level, if we sell one more bicycle, if we sell 5 more bicycles, if we sell 5 less bicycles, what's going to be our new operating income? So we can quickly go through and kind of do some what-if questions, which is important when we're talking about making decisions in business. So we'll get into our learning objectives here for the chapter. Chapter 7, Learning Objective 1, we're going to calculate the unit contribution margin as well as that contribution margin ratio. So again, it's a powerful tool that helps managers make decisions, this cost volume profit analysis. And again, it kind of simplifies our income statement. It takes a very complex business, very complex cost structure, and it really allows managers to kind of just see, all right, here's our variable expenses. If we produce one more, if we produce one less, what's that impact? So it takes a complex real life business and tries to boil it down so that way we can understand and kind of run through a lot of scenarios quickly by making little tweaks and little changes, but allowing us to see what that impact will be. So it expresses the relationship among costs, volume, and company's profits. So again, it's important that we are able to classify our expenses as either variable or fixed, and then by knowing how those behave, fixed costs stay the same in total, variable cost per unit stay the same, selling price per unit stays the same, therefore contribution margin per unit stays the same. We're able to again make assumptions, ask those what if questions, and see how that impacts our bottom line. So our components here, what we're going to be looking at and the kind of the different variables we see is our selling price per unit. And an example that we kind of see throughout the chapter, it's going to be talking about this company that sells posters. So we have our sales price per unit, the price charged for each poster, the number of posters sold, so our volume, our variable cost per poster, so how much each individual poster cost us as it relates to variable costs, the fixed cost, the fixed monthly website and maintenance and rent for this company, and then all those kind of pushed together, sales minus our variable minus our fixed, is going to give us our profit or loss for the operating income based off of the level of activity, the selling price, and our expenses. So some of our key assumptions as we go through this chapter, again, our selling price remains constant throughout the relevant range of volume. And if you remember back from our chapter 2 to chapter 6, when we talked about relevant range, that's that range of activity, generally sales level or units sold, in which our costs or our constants remain the same. So our selling price, we're going to assume, as long as we stay within our relevant range of activity, is going to be a constant. So if we sell 1, we're selling it for $5. If we're selling 10, we're selling each one for $5. So that's a constant. We already know our variable expenses are constants on a per unit basis. Therefore, we can extrapolate that our contribution margin per unit is also a constant within that relevant range. So number 2 there, managers can classify each cost as either variable or fixed. So this is where it kind of gets a little confusing and can be a little difficult. A lot of costs in real life can be a mixed cost, right? It has a little bit of fixed, a little bit of variable in there. We need to just kind of go through and make our best guesstimate of, yes, it's more variable than fixed, or yes, it's more fixed than variable. So we need to classify those into every one of our costs into each one of those categories, because if you remember back to that first slide, there is no mixed cost line there. So it really has to be fixed or variable. Inventory levels, they do not change. So that's one of our assumptions as well. So whatever we produce, we're going to sell, or whatever we buy, we're going to sell. And then lastly, and this is going to really come into play when we talk about our 4th learning objective, the product mix offered for sale remains the same. So again, if we're selling 10 items, or for every 10 items that we sell, if we're selling multiple products, it's going to be the same mix. So if we sell 10 products, 6 out of every 10 will be product A, 4 out of every product will be, or every product sold will be product B. So we can see that mix will be the same. 6-to-4 ratio is going to hold true, and it's a constant. We'll get to that a little bit as we go along in the chapter. So our first formula here, and you'll want to write this down, or our first 2 formulas really, is this contribution margin. So that's the excess of sales revenue over variable expenses. And I just want to clarify that that is sales revenue minus variable expenses. So what we're saying there is that it's the amount our sales revenue is over or increased over that variable expense. It's not division, it's just sales revenue minus variable expenses. That's our contribution margin. And we can do that in total sales minus total variable expenses equals our total contribution margin, or we can do it on a per unit basis. So it's our selling price per unit subtracted from our variable expense per unit, or variable cost per unit. So we can do it in total contribution margin equals total revenue minus total variable expenses, or on a per unit basis. Our unit contribution margin equals our selling price per unit subtracted by our variable expense per unit. And it's important, and when you see these in some of your homeworks or on the quiz on My Accounting Lab and Pearson, or on your exam, which will be next week, the week of the 19th, towards the end, you'll see that pop up. You want to make sure you get all of your variable costs. One of the things the publisher likes to do in their questions is sometimes they will give you a multiple listing of costs. Some will be variable and some will be fixed, and you got to grab all the variable costs. When we're talking about variable costs, you got to grab all the fixed costs. Don't just fall into the trap of the first one says variable, so I'm just going to use that one. So just keep that in mind. We want to make sure we grab all of the variable costs. So this is our K's poster that we'll see throughout the chapter we go through with kind of some of our illustrations. So we can see here our information. We have an online poster business. We sell each poster for $35, so that's our unit selling price. So if you're keeping notes at home, that would be your unit selling price. We then have that our variable cost is $21 per poster, so that would be your unit variable expense. So you can quickly do some simple subtraction, 35 minus 21, so our unit contribution margin, $14 per poster. And those are going to hold true as long as we're in our relevant range of 0 to 2,000 posters sold. And right now, K is at 550 posters, so well within that relevant range. So those three numbers are going to hold true as constants. Each one is going to bring us $35 more in revenue. Each one's going to bring us $21 more in variable expense. Therefore, each poster that we sell is going to provide an additional $14 of contribution margin. Our last item there is that our fixed costs, that's going to be $7,000, regardless of whether or not we sell 0 posters or up to 2,000. As long as we're in that relevant range, fixed costs are going to be $7,000. So we can see here, and in your homework or in the quiz or on the exam, you might see that they say create a contribution format income statement. And this slide is exactly what you want to produce. We have our sales revenue, so it's going to be our 550 posters sold times $35 per poster. We have our variable expenses. Again, we multiply that 550 posters, all the ones we sold, times that $21 per poster variable expense. And then we can get our contribution margin. So here they're illustrating just that you would take your sales minus your variable expenses. The other thing you could have done was 550 posters times $14 per poster to get to that 7,700. So you can do sales minus variable, or simply multiply number of units sold by that contribution margin per unit. Here they did sales 19,250 minus variable expenses 11,550. Next, we subtract out our fixed expenses. Finally, we have our operating income, $700. So that's right now, based off of the current level of activity, what we have for operating income when we sell 550 posters. All right, so that's our contribution format income statement. So on your homework, they'll ask you a couple times to prepare this for your different companies. Just have this slide up for you. It's exactly the format. Nothing too difficult, nothing too crazy. Just sales minus variable equals contribution margin minus fixed expenses equals your operating income. Holds true every time. Again, we can show this on a per unit basis as we talked about when we first saw our example 2 slides back. Selling price per unit 35, less your variable expense per unit 21, gives you that unit contribution margin of 14. Now you notice we don't do a fixed cost per unit or a net operating income per unit because those two items would not be constant, so there's no point of really, or it's not helpful when we're trying to go through this what if scenario. It doesn't provide any additional benefit from finding your fixed cost per unit, because as we add one more unit that we sell or 2 more units that we sell, that fixed cost per unit is going to be going up or down depending on if we're selling one more or selling one less. So those aren't constant. That fixed cost per unit is not constant. Neither is that net operating income per unit. Those would not be constants. So we don't waste our time calculating that to use in our what if scenarios in the CVP analysis. So we can see here for every $14, or K earns $14 every time she sells a poster that can be used, first to pay for those fixed expenses, next it would be to earn a profit. So when Kay's starting off, her very first poster she sells is going to bring her $14 to the contribution margin. That's going to pay for her first $14 of fixed expenses. So she's going to keep selling. First, she pays off all of her fixed expenses. So once she gets past that $7,000 fixed expense per month, that's her threshold. That would be her break-even point, and we're going to calculate how to come up with that break-even point in a minute. So she first pays her fixed expenses. After she covers her fixed expenses, every $14 of contribution margin is going to go to her bottom line, be her profit. So next formula we want to keep in mind, this is our contribution margin ratio. So this is the ratio of contribution margin to sales revenue. So we calculate this, and we can do it one of two ways. We can do it on a unit basis or in total. Make sure if you're doing it though, if you're taking your unit contribution margin, don't then divide it by your total sales revenue. That's not going to give you the correct contribution margin. If you're going to do contribution margin per unit, do your sales price per unit. So that's our second line there. Our formula is contribution margin per unit divided by sales price per unit. Next we can also do it in total, so it's our total contribution margin divided by our total sales revenue. And once you calculate this ratio, because our unit contribution margin and our selling price per unit, those are both constants, this ratio is also going to be a constant. All right? And because the way math works, if you do it in total at any given sales level, the sales revenue and contribution margin, while those can change in total, their ratios are going to be the same. So you got the same exact ratio if you do it on a contribution margin in total divided by sales price or sales revenue in total, or if you do it on a per unit basis. So we have here, for example, for Kay, her calculations, her $14 contribution margin divided by her $35 selling price per unit gives you 40%. Or at 550 posters, if you go back to that contribution format income statement a few slides back, her contribution margin was $7,700 divided by that total sales revenue, $19,250. Again, 40%. So you can do it either way. It's going to come out to the same exact contribution margin ratio. And what that tells you is for every dollar that Kay now sells, every additional dollar of revenue, 40 cents is going to go to her contribution margin. The other 60 cents or 60% is going to go to cover her variable expenses. So that's what that tells you. So when you're working through your homework problems or you're working through the quiz or your exam next week, you can really go through and you can quickly see that if I have my contribution margin ratio, I can quickly calculate at any given sales level what's going to be my total contribution margin simply by multiplying your contribution margin ratio times your sales dollars. So if you have a contribution margin of 40% and your total revenue was $100,000, $40,000 is going to be your contribution margin. So that's going to be helpful, especially in some of your problems where they just give you contribution margin percentage and they say what would be your net operating income at this level, at that level, etc. Multiply your CM ratio by sales to give you your contribution margin at different levels of sales. So that's a quick shortcut way of doing that. Sometimes they might give you your variable expense ratio. So just keep in mind that if you have your variable expense ratio, that's going to be your variable expenses divided by your total revenue. Or if you know your CM ratio, 40%, you know your variable expense ratio has to be 60% because those two numbers together have to equal 100%, which brings you back to those total sales. Okay, so just keep that in mind. Sometimes they might give you your variable expense ratio, and you can do one of two things. You can multiply that by your sales, and that'll give you your total variable cost, or you can take the inverse of that and 100%. So if you have a variable expense ratio, say, of 75%, you know your contribution margin has to be 25% because you know you have to get back to 100% with those two numbers. So you can come back, get your CM ratio, multiply it by your sales to give you your contribution margin. So you can work with this a lot. It's an important ratio. It really helps out a lot as we start going through this and going through some of our problems. So next, like I was just saying, we can go through and we can use our CVP analysis to find our break-even point and our target profit volumes. So first, let's define our break-even point. So our break-even point is basically where our sales levels at which our operating income is zero. In other words, it's where all of our revenues, so total revenues, equals all of your expenses, total expenses. So every dollar of revenue from your customer going right out the door to pay for your vendors and for your employees, etc., all those expenses. So at this point, and why we want to know what our break-even point is, and we're going to calculate it both on a number of units sold and on a sales dollar level, how much sales do we need to have a break-even. Why this is important is because it gives you that kind of exact point, that exact number of units you need to sell, where you're kind of on the brink of making a profit, but at the same time, you could be losing money. So it's that difference between, it's kind of that purgatory of your business. One more unit sold or one more sales dollar, you're going to have a profit. One less unit sold or one less dollar, you're going to have a loss. It's kind of that razor's edge where you are kind of, you're not making money, you're not losing money, everything's kind of in balance. And if we're talking about a business, we want to tip the scale so we go profitable. We want to have more revenue than our break even. We want to sell more units than our break even. But this allows us as a business to kind of understand, all right, here's at least where we have to be to at least cover everything, cover all of our expenses, cover all of our costs. Anything above that, we're going to be in the black, so to speak. We're going to be making that money. Anything below that, we're going to be in the red. We're going to be losing money. So we have, first, we're going to figure out using the unit contribution margin, what's our break-even point. And just keep this in mind, and you want to write this down in your notes or just kind of start next to this slide, depending on how you're following along at home. You can basically skip the first half of the slide and just go down to our shortcut formula. And just keep in mind, for our formula for break-even and for target profit, earning a target profit, it's the exact same two formulas that we use. So our formula is, in order to get the number of units to be sold, we're going to take our fixed expenses plus our operating income, which if the company or the question is asking you, let's get the break-even point, that operating income is going to be zero. We'll see when we go to our target profit analysis, that's where we plug in our target profit. But in this case, our break-even, our target profit is zero. So whenever you see break-even, just know it's always going to be zero for that operating income. We divide that by our contribution margin per unit. And this is going to tell us how many units do we need to sell in order to get a break-even, to be in balance where revenues equal expenses. So our example here for K, sales in units, 7,000 of fixed expenses, plus 0, which is our break-even, to get divided by our $14 contribution margin, and that equals 500 posters. And if you remember back from our example, she's currently selling 550 posters, and if you recall, she had a profit of $500 or $700, excuse me. And if so, at 550, she is 50 units above our break even, so we expect her to have a profit based off of this break even point analysis, and she in fact did. In fact, you can say your $14 per poster times that additional 50 posters she's above her break even, that's going to be her operating income. So 50 times 14 is going to give you that $700 profit. So you can see there how we can quickly go through, because we know our break even, we can just multiply the amount of units we're above our break even, and that's going to tell us what our profit should be. And if we go back to that slide at the beginning of the chapter, in fact was. So that's how that kind of works out and why it's important to know this break even. So it's important here when we're trying to calculate our break even point, when we divide by contribution margin per unit, that's going to tell us how many units we need to sell in order to break even. Next we have, if we need to figure out what's the sales in dollars, so our sales dollars we need to achieve in order to break even, it's going to be our same numerator, our fixed expenses plus our operating income. This time, however, we're going to divide by our contribution margin ratio. So again, our contribution margin ratio, that's our contribution margin divided by our sales. So in this case, for our example here, we have our $7,000 fixed expense. And again, because we're asking for break even, our operating income is zero. This time, instead of dividing by our contribution margin per unit, we divide by our contribution margin ratio of 40%. And that tells us we need to have sales of 17,500 in order to have a break even for K's poster company. So it's the same formula numerator-wise. Difference is we're going to use our CM ratio to give us our sales dollars. Next, we're going to have two formulas, and you'll see they're the exact same formulas we just had for our break even, but this time we're going to earn a target profit. So in this case, we're going to say how many posters does K need to sell in order to earn a profit of $4,900. So again, our numerator is going to be the exact same fixed expenses plus our operating income. Just for these types of problems, when we're not just trying to figure out the break even, i.e. our operating income of 0, we're just going to include our target profit, so $4,900. And again, if we want to know the number of units to sell, we're going to divide by our contribution margin per unit, so 14. So in order to earn a profit of $4,900, she's going to sell 850 posters. To figure out the sales dollars we need, again, same numerator, this time divided by our CM ratio. So for both of these problems, target, profit, or break even, if we are trying to figure out the number of units that we need to sell, we divide by our CM per unit. If we want to know the sales dollars to get to a target profit or a break even, we're going to divide by the CM ratio. All right. So what I would do if I were you guys listening at home is have your notes, have your definitions, and have your formulas, and kind of just start with what's your CM per unit, what's your CM ratio, and then build into these break even, these target profit. If I want number of units, divide by CM per unit. If I want the number of sales, the amount of sales dollars, divided by the CM ratio. And just kind of have these going down. That way, you know if you need the target profit in dollars, we need our fixed, our operating, and our CM ratio. Then right above that, all right, how do I get my CM ratio? Right below that, how do I get my CM ratio? And then how do I get my CM? Just so you can kind of just build into these equations, because it's really, if you write that down and you keep it organized, it's not that difficult. It's, adding and then division. It's just keeping everything organized and just trusting the formulas that you have and trusting your notes. That's what this is all about. This chapter is just kind of keep everything clean, keep everything organized, and just understand and visualizing the relationship between these numbers. And that way you can work with the formulas when it's just straightforward. Here's our sales price, here's our variable expenses. But then you'll see in some of your homework problems, they start with basically, here's your target profit, and let's work backwards to get a different number. So it's just setting up the formulas correctly and just knowing the different variables, just keeping that organized. So we have a couple of quick checks here, and I normally, in class we'd go through these. So what I'm going to do is, I'm going to give you a minute, read the problem. You can even pause it if you want to. But again, just give it a shot. See if we can figure out what is the break even in sales dollars for our company here. So I'm just going to, my suggestion is just put this on pause, read through. I'm not going to pause it. I'm not going to stop for the video purposes, but just pause the video, read through, and try to come up with your answers. It's just a quick check. It doesn't matter if it's right or wrong, but you can use those formulas that we just talked about to try to solve this. So here we're trying to find what is our break even in sales dollars. All right. So pause it here, give it a shot. If you get it right or if you get it wrong, doesn't really matter at this point, but just try to work through it with your formula. All right, so pause it here, and I'll welcome you back in a second. All right, so welcome back now. So I assume you paused it, or you just listened to me hold for 2 seconds, and now you're listening to me talk again. But if you gave it a shot here, we're trying to find our break even in sales dollars. So what you would do is you'd set up your formula. So if you remember your formula from a couple slides back, or if it's in your notes, we're going to take our fixed expenses, we're going to add in our target profit, and because we're looking for our break even in sales dollars, we're going to divide by our CM ratio. All right? So what we need for that is first we need to know what's our selling price. I'm going to use my pen here. So we need our selling price. So we're going to sell each unit for $1.49. All right? Next, we need to know what is our variable cost per unit, and we're going to subtract that from our selling price. So we're going to take our $1.49 minus our 36 cents, and that's going to tell us what our contribution margin is for each one of these units. So $1.49 minus 0.36, that tells us our contribution margin, so our CM per unit. And pardon my writing skills here, they're not great. $1.13. All right. From there, we need our CM ratio, so we're going to divide that by our $1.49 again. So our contribution margin, $1.13, divided by our $1.49 selling price. Just bear with me here. writing in real life is hard enough, let alone on a computer. So what that's going to equal is our CM ratio, trust me, that's a point, and we're going to say 758%. So 0.758, that is wonderful right there. So next we're going to take our fixed expense divided by that CM ratio of 0.758, and that's going to give us what is our break even in sales dollars. So we'll skip ahead there. So we have there written out better than my wonderful writing. And we can see our break even in sales dollars, 1,715. All right. The average of 2,100 cups of coffee for this particular problem, that was just thrown there for some extra information. We didn't necessarily need it. So that's what I was trying to tell you guys. Stay organized with these problems. Understand what you need, what you don't need. A lot of the times they're going to give you a little bit of information that you don't need, a little bit extra information. And where a lot of students get kind of tripped up is they try to use every number, every bit of information that's in a problem. Avoid that temptation. Know what you're looking for, know your formulas, and you'll be okay. All right, so next we have another break even here. So we don't know in this time, though, what is the break even in sales in units. So we're going to use our other formula to try to solve what is our break even in the number of cups of coffee we need to sell in order to break even. All right, so take another minute, pause the video here, give this one a shot, try it out with the formula. Again, if you get it wrong here, if you get it right, great. If you get it wrong, don't worry about it. We'll learn from our mistakes. That's the best way to learn for accounting, is giving it a shot, seeing what you need, what you don't need, and then just letting it become repetition, let it become natural. All right, so pause it, give it a shot, unpause it when you're ready to go. All right, so now we're going to go through this one and see how we do it. So I'm not going to write on the screen again. That was a fun adventure. I'm just going to skip ahead to the answer. So if you've gotten your answer, hopefully you get it right. You got A, B, C, or D there. So we'll see here correct answer is D. So our break even and the number of units in order to sell the break even, it's our fixed expenses. Again, we don't need to put that target profit in there because if it's break even, that target profit is always zero. We always just, basically just skip it. So it's our fixed expenses, 1,300, and this time we're just dividing it by our CM per unit. So $1.49 minus 36 cents gives us that $1.13 CM per unit. All of that, and we're going to divide our 1,300 by that $1.13. That tells us that we have 1,150 cups in order to break even. All right. So next we're going to go on to use our CVP analysis to measure the impact of changes in business conditions. So again, here, this is where we can really use our CVP to really go through and make some good business decisions, understand how changes, fluctuations in our business is going to impact our bottom line. So sensitivity analysis is basically what we're going to be going through here and talking about, and this is for preparing for increasing cost, pricing pressures, and other changes in our business conditions. And we do that by going through and say, what if? What if our sales price has to change? What if our costs change? Our vendors suddenly charge us more, charge us less? What if the sales mix changes? So this is really all those questions that we ask ourselves. And if you're a business owner or you're a manager, some of these can keep you up at night. If you had just barely making by based off of your current activity, your current levels, your current margins, you stay up at night and you say, what if? What happens if our selling price suddenly has to go up or go down? What if our variable costs suddenly have to go up or they go down? What impact might that have? And if you have your financials set up with the CVP analysis, because remember, this is managerial accounting, not every business is going to go through or really understands that they can do this. If you have this, you understand how your costs behave, you can quickly go through and make these changes through the CVP analysis, and you can kind of answer these what if. All of a sudden, if our sales price has to go down, what impact does that have? What recourse do we have? What do we need to get ready for? All right, so changes in that selling price. So this is what happens. One, our break-even point is going to change. So if we think back to that break-even calculations, that target profit calculations, our selling price, if that suddenly goes down, that denominator is going to become lower. So we need to sell more units. We need to have more sales dollars in order to get that break even. So all else the same, if our sales price drops, our unit contribution margin is going to go down, and therefore the volume needed to break even or to achieve a target profit is going to go up. So if we're getting less for each one of our units sold, we need to sell more units in order to get that target profit. At the same time, if the sales price increase, that's going to lead to a higher unit contribution margin, and therefore we need to sell less in order to get that break even. So each one of them is going to be a little bit more profitable. Excuse me. It's going to be a little bit more profitable than it was before with that lower sales price, and therefore need to sell less. All right, that's just quickly going through, understanding what if sales goes up, what if sales price goes down, what's going to have that impact. And what a business would then say is, if our sales prices are going down, we need to counteract that lowering of our contribution margin. Maybe we change, or we try to adjust those fixed expenses or adjust those variable costs to match that decreasing in sales. At the same time, if our sales price is going up, maybe we try to make some additional changes, or maybe it's because we have some changes in our cost structure that is forcing us to have an increased sales price. When we're talking about our variable costs, again, if we change our variable cost, again, our break-even point is going to change. Might go up or down, depending on if our costs are going up or down. But a unit contribution margin changes. Higher variable costs have the same effect as lower selling price. They reduce the contribution margin. So again, if our sales price is going up, our contribution margin increases. That would be the same result as if our sales price stayed the same, but our variable cost goes down. If our selling price goes down, that impact is the same as if our variable costs were going up. So it kind of work together because it's just A minus B. So if A goes up and B stays the same, C goes up. But at the same time, if B goes up and A stays the same, our C goes down because it's A minus B. So just keep that in mind, that relationship of how those two numbers work together. So all else remaining the same, if our variable costs are going up, our contribution margin per unit is going to go down, and therefore we need to sell more because every one of our units sold is basically less profitable than it was before. Again, if our variable costs are going down, our unit contribution margin is going up, and therefore our volume needed to break even to achieve a target profit, that's going to go down. So I like to think of this one, our variable costs, and this is probably where we see it a lot in different businesses, and maybe in some of the businesses you guys work for or work in or are familiar with, your variable costs can move a lot. And one of the areas I see this, or we've seen this in the past, really have an impact. Restaurants. The restaurant industry is affected by this a lot. You know, if you look at a restaurant, their menu prices for most items, they're fixed. Maybe once a month or once a quarter they'll change, but for the most part, most restaurants you go in there, they're the same. And so what they're doing, the revenue for them, that dollar, if you go into a fast food place, it's $2 for a cheeseburger, that revenue point is locked in because they want their customers to have that same experience, have that same kind of dollar spending value wherever they go, whatever location they go to, time in, time out. Where they're going to be profitable or not profitable is how well they control their costs, how well they control their variable cost of that cheeseburger that they made that they're selling for $2. So maybe that means if their costs are going up, one of their strategies might be to reduce the amount of kind of cheeseburger that goes into your cheeseburger. However, when your costs are going down, they're able to give you either more, or maybe they can add some other incentives for you to go and buy there. So it's still that same $2, but their costs have gone down, so maybe they can throw something else in there. Other restaurants, like if you have just a regular non-chain restaurants, the swings in cost can go up or down, and not always can they match that increase with revenues. They can't increase if suddenly their delivery of produce is more today than it was last week. They can't necessarily always go up and catch that up in the menu price. They can't suddenly pass along that additional cost. So with a non-chain restaurant, this change in variable cost, it's important for them to know, okay, how much of this can I actually absorb? How much do I have as a buffer? And we'll talk about that a little later, that margin of safety, so to speak. But as you go through, how much can I absorb? How much can I not absorb? When do I actually need to absolutely change my costs if my variable costs are going up? At the same time, and you'll see this a lot in businesses, if their variable costs are going down, they're more profitable, most businesses aren't as quick to reduce their selling price, pass along those savings when they have savings on their end on their variable costs. Another one you'll see that a lot too is gas stations, right? Price of gas is going up. You hear that on the news on a Tuesday night. You go to the gas station the next day, it's gone up a nickel or 10 cents. Here on the nightly news the next week that the cost of gasoline is going down, the next day it's still the same price. They don't quickly change those costs. So they pass along the cost to you if they have additional costs, but they don't always pass along the savings when they have that reduced variable cost per unit or variable cost per, in that case, gallon. Next we have our fixed cost, and again, that changes your break-even point or that target profit point, because if you remember, the numerator had your fixed cost plus your operating income. However, it does not affect the contribution margin, and that's because if you remember, contribution margin is sales minus variable. Your fixed has no impact. So all else remains the same. If our fixed costs go up, we need to sell more to get our break-even or earn a target profit. If our fixed cost goes down, then we need to sell less to get to that break-even or that target profit. So next we're going to go through and basically calculate our target profit and our break-even, but instead of having one product or one kind of line, we're going to have multiple products in our company. So here's where we were talking about earlier, one of our constants is our sales mix. And that's the case, that's the combination of products that make up our total sales. And again, that was kind of my illustration. The sales mix is basically you go through a company and you try to reduce it down to your smallest order size or smallest number of products, and you just say for every 10 products, how many is it product A versus product B, and that sales mix we're going to assume is going to stay the same. So for any 10 products that we sell, 5 will be product A, 5 will be product B, or 7 will be product A, 3 will be product B. Whatever your sales mix that you come up with, and for most businesses it might be like for every 10 products, 5 3/4 are product, because obviously it's going to average out. But that sales mix, whatever we come up with, that's going to be the same. So a couple of things to keep in mind. All else equal, businesses are going to want to sell products that have a higher contribution margin, because again, more of your sales dollars can go to pay for your fixed expenses and then pay for your profits. And then we're going to use our weighted average contribution margin and our weighted average contribution margin ratio, and that's going to weigh out each contribution margin by the relative number of units sold. So that's what we're going to calculate, and that's really going to be our only difference between a one-product company and a multi-product company. Is instead of getting our contribution margin per unit, we're going to get our weighted average contribution margin per unit based on that sales mix. So we have here, for K's company, we're going to calculate our weighted average contribution margin. And so what we have to do first is figure out what's our sales mix. So if you go here on this diagram, we go to line 5, multiply the sales mix, and the company or the problem is going to tell you what the sales mix is. So here what we're saying is for every 8 posters we sell, 5 are going to be regular, 3 are going to be large. So that's our constant sales mix. So every time we sell 8 posters, it's going to be 5 regular, 3 large over time. So what we do is we calculate our contribution margin per unit, and we've already calculated it for our regular posters. That's what we've been going through this chapter, that $14 contribution margin per unit. Now we're introducing this large poster that apparently we sell for $70 per poster. We have a variable cost of $40 per poster, so we have a contribution margin $30 per poster. So under a normal circumstance, that's where we would go with those two contribution margins if we were individual companies, and we calculate our break even and our sales dollars to break even. But because this is the same company, we have multi-products, we multiply it by our sales mix. So again, for every 8 posters, 5 would be regular. So we're going to take our contribution margin for our regular times 5, gives us a contribution margin of 70. And then we're going to take our 3 large posters that we sell in our sales mix times $30 per unit, and it gives us a contribution margin of $90. So we add those two together. So we have, of our total basket, that D column, we have 8 posters for a total of $160 contribution margin. So our weighted average contribution margin for our sales mix, $20 per poster. That's what we're going to use to calculate our break even. So we plug it in, same exact formula, only difference from before, it's our weighted average contribution margin versus just a contribution margin. So for here, we have 7,000 of our fixed costs. Again, this is going back from that very first slide in the chapter. Again, it's a break even, so it's 0. So now we divide by that 20 that we just calculated on the previous slide. So that tells us we need to sell 350 posters. We can now break that down based off our sales mix. Of the 350 posters, 5/8 of that is going to be 218.75 regular posters. Of that 350, 3/8 of it, or 131.25, is going to be our large posters. And if this was a problem, you could leave it as the decimals there, 0.75, 0.25, but my advice, just round it up, because in reality, we can't sell 0.75 poster or 0.25 of a poster. So it's really, we need to sell 219 regular posters and 132 large posters in order to break even. So when we have multi-products, because we have rounding, because we have that weighted average, we're not going to come up with a even number. So you just round up. So even though your break even, technically, if you sell 219 and 132, you'd show a little bit of a profit. When we're talking about a break even analysis, you'd rather have a little bit of a profit than shoot for a break even where you're actually shooting for a loss. So just always round up there. Next, if we're going to do our break even in sales revenue, we calculate our contribution margin again for our total basket, and then we divide it by our sales revenue for that total basket. So the first half, so rows 2, 3, 4 is what came from that other slide, 2 slides back. Next, we're going to multiply each one in our sales mix by the selling price. So we're going to sell 5 regular posters, so that's B7, 5 regular posters, and we sell each one of those for $35. C7 and C6, we're going to sell 3 large posters, because our sales mix is 5 and 3. 3 large posters at $70 per poster, so we're going to have sales revenue of $210. So we get our total sales revenue for our basket, our sales mix, $385, and we have our contribution margin for that basket, $160. So we're going to find our weighted average contribution margin. Contribution margin divided by our sales price. So $160 divided by $385. That gives us our weighted average contribution margin, 41.56%. Again, plug it into our formula. Only difference this time, instead of contribution margin ratio, it's your weighted average contribution margin ratio. So it's again, 16,844 would be our break even in sales revenue, sales dollars for this company when we have multi-products. So it's the same formulas that we had if you just have one product. The only difference, the only quirky thing, we have to get that weighted average contribution margin and contribution margin ratio. Lastly, learning objective 5, and just to kind of throw this out there, for learning objective 4, just make sure you understand it. Make sure you understand the steps. Your homework, none of those problems involve that multi-product. It's just important on the quiz. There might be a multiple choice or two just related to what's the additional steps we have to use to calculate that. So what we really focus on for this chapter, learning objectives 1, 2, 3, and 5. So here, we talk about some of the common risk indicators in business. One of the things you'll find out as you get into the business world, you start working for businesses or accounting firms or marketing firms or whatever, is that every business has some sort of risk involved with it. That's just name of the game for business. There's risk. What we try to do as business people, as managers, as owners, is try to reduce that risks. First thing we have to do, though, is understand what our risks are. So with that in mind, we have a couple of different factors that impact the risk. The general health of the economy is a big impactor, has a big factor on the risk of a business. Some industries like luxury brands, luxury items, luxury service, those have a high level of risks directly tied to the economy. If you think about a luxury brand or a luxury item, 5-star hotels, expensive cars, makeups, perfume, some of those expensive things. If the economy takes a downturn and people have to start cutting costs, cutting expenses, cutting things out of their lives, it's generally going to be those luxury items that they have to cut out. That's going to be what goes away first. Items that are staples, that are like required, so grocery stores, food, healthcare, a lot of those things are more insulated in the economy, has less risk, has less impact on the economy, because especially for things like grocery stores or gas stations, people always need those. They can't just skip getting gas in their car. Maybe they do it less frequently because they're traveling less, but if they have to go to work, go to school, at some point they're going to have to fill up. They need grocery store, they need food, they need drinks for their house and for their family, etc. So while they might see a small decline, those staples, they're going to be pretty steady regardless of the economy. Luxury items, they're going to see big spikes if the economy is going good. They're going to see big dips if the economy is not going good. Some of the other factors, industry of operation, current volume of sales, those can impact some of the risk factors of the business. And then the fixed versus variable cost, that can have a big impact on how risky a business is as well. And we'll see that in a minute. So two of the formulas that we'll want to know and we'll take away from here and that you will be tested on, margin of safety, operating leverage. Those are two that can kind of help us look at how risky a business is. So we start here with our margin of safety, and that's our excess of actual or expected sales over our break-even sales. So what that's saying, basically our formula is, what is our sales level now, or if we're doing a budget, what's our expected sales, and compare that to our break-even sales. And what that tells us is a drop in sales the company can absorb without incurring a loss. So if you have a margin of safety of $50 versus a margin of safety of $1 million, what that's saying is, for that first company that only has a margin of safety of $50, they only can absorb not making or having $50 less in sales or expected sales before they're at their break even, and below that 50 they're going to be at a loss. Compared to that company with $1 million margin of safety, they can absorb having their sales or their expected sales drop by $1 million before they are at that loss. So generally a higher margin of safety equals less risk for that business, especially if we're talking about an investor trying to go into it or a banker trying to decide whether or not they can loan that company money. So our formulas here, so we're going to assume K generally sells 950 posters a month. So we're going to have our 950 actual or expected sales minus our break-even sales that we would have calculated earlier in the chapter. So we have a margin of safety of 450 posters. That means normally we sell 950, but as long as we don't go down 450, well, at the very least we'll have a break-even, but as long as we're in that margin of safety, at the very least we'll have a profit, unless we get down to that 450. If we have loss or if we lose sales of 451 posters, so one poster above that margin of safety, that's going to tell us we have a loss. So if we have a bad month and we're off on that expectation and we're off by more than our margin of safety, means we're going to be in the loss. We're going to be losing money. We can also express it in sales dollars. So we can do our 950 posters times our $35 per poster minus our 500 break-even posters times 35. That tells us that our margin of safety in sales dollars is $15,750. So again, I'd get these two formulas down. You'll need that for one of your homework problems. I believe it's problem 63. They ask you for your margin of safety. So you need to know what are expected sales or actual sales, depending on how the question is worded, and we want to know what's our break-even sales in order to calculate this. And for all of your homework problems, regardless of whether or not they're asking for margin of safety, contribution margin, break-even, target profit, etc., just be on the lookout. Make sure you read the question and make sure you're answering the question they're asking you, right? If they're asking you for your break-even in sales units, don't give them sales dollars. And at the same time, if they're asking for sales dollars, don't give them the break-even, okay? Just make sure you're reading the question thoroughly. We can also express it as a percentage. So we take our margin of safety divided by our actual or expected sales. And we can do that based off of units or sales dollars. And again, because that relationship of contribution margin ratio or contribution margin per unit, selling price per unit is in, that relationship holds true. Those are both constants. Either way, you should come out to the same exact percentage. Next, we have our operating leverage and operating leverage factor. And that's the relative amount of fixed and variable cost that make up total costs. So we have here our operating leverage factor is how responsive a company's operating income is to changes in volume. And our formula is your contribution margin divided by your operating income. All right? And so generally, the greater the operating leverage factor is, the greater an impact on a change in sales volume has on operating income. So what that's saying is, and how you can use this in your problems or in your real life, you get your contribution margin, you divide it by your operating income. That's going to give you your operating leverage, or your operating leverage factor. So let's just say you have two companies. And we can write this down if it helps you out. So you have operating leverage for one is 2, and you have an operating leverage for your second company is 5. So what that tells you is the factor by which any change in your sales, so your top line, any change in that, what that basic impact is on your net operating income. So to illustrate that, let's say we have a company A has an operating leverage of 2. If its sales increase by 10%, so we have 2 operating leverage, we're going to multiply that by that change in revenue, 10%. That's going to tell us that our net operating income should equal 20% of what it used to be. So if a 10% change in sales is going to result in a 20% change in net income. At the same time, if we have company B that has an operating leverage of 5, and it also has a 10% increase in sales, 5 times our 10% increase, that's telling us that our bottom line, our net income, should increase by 50%. So you might say, hey, I want to have a very high operating leverage, but just keep in mind that can also work against that business. If there's a negative 10% change in business, that second company with the 5 operating leverage and a negative 10% down in sales, that's going to have a negative 50% impact on that bottom line. Whereas the company with a operating leverage factor of 2 with a negative 10% change in sales would have a negative 20% decrease in sales. So just keep that in mind. That operating leverage is telling you how sensitive or how drastically a change in your top line sales will have on your bottom line operating income. So the slides have an illustration here with your proof of how that change will be. But basically what it's saying is what we just said there. It's you take your operating leverage, contribution margin divided by your operating income, and that factor is what your net income will change based off of a percentage change in sales. So we have through our K company that we've been using through, has an operating leverage of 2.11, which was its contribution margin at 950 posters times 14, 13,300, divided by its operating income, 6,300. So your operating leverage, 13,300, divided by $6,300 is 2.11. So that's telling you if K's volume changes by 1%, her operating income will change by 2.11%. So again, that factor, 2.11 times her change in sales is what her change in bottom line will be. All right, so just last 2 slides here, some characteristics of our high operating leverage firms. So high operating leverage companies have the following: higher fixed cost and lower variable cost, and then a higher contribution margin. For high operating leverage companies, changes in volume significantly affect operating income. So they face the higher risk as well as higher potential for reward. All right, so if we think about a company that has a high amount of fixed expenses, so a very high contribution margin, but they also have very high, so most of their expenses are fixed. If you think about that, if they have $1 million of fixed expenses, if they have a year where they have $500,000 of sales, they're going to have a big loss because they still have to cover all those fixed expenses. Whereas if they have a year with now $5 million of sales, they're going to have a much higher profit because, again, they're going to absorb that $1 million of fixed expenses. After that, they're not going to have a lot of expenses. So a lot of that additional revenue over that $1 million of fixed expense, that's going to be more and more profit. And our examples there, golf courses, hotels, rental car agency, theme park, airlines, cruise lines, the common thread there is They're all service industry. So a lot of service industries have high fixed costs. And all of those are businesses that basically own a significant dollar amount in assets, right? If we think about a airline or a hotel or a cruise line, these are all businesses that have significant fixed costs. They had to buy the airplane, they had to buy the hotel, they bought the boat or they built the boat. So they have this significant fixed cost, and they're operating, and they're going to have, for the most part, all those costs, whether or not they have one guest or one passenger on the cruise line or on the airplane. Whereas if they have multiple people, they have, if they have a full plane versus they have a 50% full plane, they still have the same amount of fixed costs. They need to have a pilot. They can't, if this plane only has 100 people and that plane has 200 people, they can't just be like, all right, we won't have a pilot, or we'll have a junior pilot or an intern go fly that plane. They have to run it the same way, regardless of whether or not there's one person or a bunch of people in that using that service at that particular time. Which is why you'll see on a lot of these, if you think about a golf course, a hotel, an airline, a cruise line, if you think about all those deals where last minute, sign up now for an airline, right? If you wait before, the night before, the morning of a flight, you can sometimes get a really, really cheap flight. And the idea is, or a really, really cheap hotel room, the idea is that they have that fixed cost already that they're going to absorb. So even if they can't get their full normal selling price, if they can still get some amount of revenue, at least that can go and help pay for some of that fixed cost. Because whether or not you stay that additional night in a hotel or you take that flight, they're still going to have that hotel room. They're still going to have to pay for it. They're still going to fly that airplane, whether or not they have one empty seat or 10 empty seats. They're still going to fly that airplane. So if they can get just a little bit more money as kind of the clock's running out until that service will be provided, that's just going to go out of that bottom line. And that's why most of these services, they're going to have a high operating leverage because they already have the cost, whether or not they have a customer or not. They still have to pay for that asset that they're providing the service for. Low operating leverage firms, they have higher variable cost, so all their costs are related to basically what their volume is. They have lower fixed costs. So we have a lower risk and lower potential for reward. Because if we think about it, if we have a very high variable cost makeup, every additional unit sold is going to bring on an additional variable cost. So if we have a lot of sales, we're going to have a lot of variable expense. Whereas if we have little to no sales, we're going to have little to no variable expense. So in that case, these companies, their bottom lines, their net income, is not going to drastically swing one way or the other, whether they're having a good year or the bad year. It's going to be a more steady bottom line. That change, that operating leverage factor, that's not going to have as much of an impact, because if we sell one more, we're going to have an additional variable cost. So that potential giant, huge year of sales is going to also carry a potential giant, huge year of variable expenses. So some of our examples there, merchandising companies, so retail stores, fast food restaurants, again, businesses where, for the most part, their costs are going to be associated with selling additional, so selling more, right? If a clothing store doesn't have a big sales week, they're not going to have to replenish that inventory as quickly. So their costs are directly related to their sales. So there's not going to be giant swings in net operating income. It's going to be more of a steady, kind of slight uptake, as opposed to a high operating leverage. They can see drastic swings one way or the other, day to day, month to month, etc. All right, so that is the end of chapter 7. So for this week, in addition to going through these slides and reading your book, you have a little bit of homework, a couple problems on My Accounting Lab. You have your quiz on My Accounting Lab. There's going to be no posting this week. Instead, I'm going to post a kind of worksheet that you can go through to kind of help yourself out. It'll be optional, but I suggest you go through. It's going to be 6 or 5 problems just to help illustrate. And what I'll do is towards the end of the week, I'll post the answers for that. And that'll help you with your homework a little bit. It'll also help you with your online quiz. So hope you've enjoyed it. Next week after this, so this week we're going to cover chapter 7. The next week we will have our first exam for the semester. It'll cover chapters 1, chapter 2, chapter 6, and chapter 7. So it'll be online. Again, it's an online class, so everything's online. So it's going to be online. We're we're also going to have a live, 2 different sessions. We'll have a live bonus review where you can earn some extra bonus points going into that exam. And I'll explain that more next week. So hope everyone has a great week. Just be on the lookout for there might be a survey question to see if what times work best for you for those live kind of broadcast bonus days. That way we can get as most people as possible and give everyone a fair chance. But other than that, if you have any questions, email me, send me a message, and we'll talk next week. Thank you.